The London Stock Exchange, home to the FTSE 100 index, has recently experienced a significant downturn. This has sent ripples through the financial community, causing a wave of concern and speculation about the future. The FTSE 100, which tracks the performance of the 100 largest companies listed on the exchange, has dipped below the 8,000-point mark for the first time since April. This drop is particularly alarming as it erases the steady gains that had been made over the past several months, signaling potential trouble ahead. This decline represents a substantial drop, wiping out gains made earlier in the year and sparking concerns among investors and analysts alike. The sudden shift has left many questioning the stability of the market and the factors that could be driving this unexpected downturn. While market fluctuations are not uncommon, the severity and speed of this recent downturn have raised eyebrows and prompted questions about the underlying causes. Analysts are now scrambling to understand the full scope of the situation and what it might mean for the future of the market. A confluence of factors has contributed to this slump in the London Stock Exchange, with international events playing a significant role. Geopolitical tensions, trade disputes, and economic slowdowns in key markets have all added to the uncertainty. While the UK economy itself has shown resilience, global economic headwinds have created a climate of uncertainty and risk aversion among investors. The interplay between domestic stability and international volatility is creating a challenging environment for market participants. These external pressures, coupled with domestic challenges, have created a perfect storm for the London market, impacting investor sentiment and driving down share prices. Issues such as Brexit-related uncertainties and domestic policy changes have further compounded the situation. The FTSE 100's decline is not an isolated incident, as other major stock markets around the world have experienced similar downturns. This global trend suggests that the issues at play are not confined to the UK alone, but are part of a broader economic pattern. This interconnectedness highlights the global nature of financial markets and the susceptibility of even established markets like London's to external shocks. The ripple effects of economic events in one part of the world can quickly spread, affecting markets everywhere. The current situation underscores the importance of understanding the complex interplay of factors that can influence market movements and the need for investors to stay informed and adapt their strategies accordingly. In these volatile times, staying ahead of the curve and being prepared for sudden changes is more crucial than ever. One of the primary drivers of the London Stock Exchange's downturn can be traced back to economic concerns emanating from the United States. The US economy, the world's largest, has been grappling with a number of challenges, including persistent inflation, rising interest rates, and fears of a potential recession. These concerns have rippled across the Atlantic, impacting investor confidence globally and sending shockwaves through international markets, including London's. The US Federal Reserve's aggressive interest rate hikes, aimed at curbing inflation, have had a ripple effect on global markets. Higher interest rates in the US make US assets more attractive to foreign investors seeking higher returns. This can lead to capital flight from other markets, including the UK, as investors seek to capitalize on these higher yields. Consequently, the demand for UK assets, including stocks listed on the London Stock Exchange, may decrease, putting downward pressure on prices. Furthermore, the US dollar's strength against other major currencies, including the British pound, has also contributed to the London market's woes. A stronger dollar makes US imports cheaper for British consumers, but makes British exports more expensive for buyers in the US, potentially impacting the bottom line of UK companies that rely heavily on transatlantic trade. This currency fluctuation can further dampen investor sentiment towards UK-listed companies, particularly those with significant exposure to the US market. Adding to the anxieties surrounding the US economy, major technology companies, which have been among the stock market's darlings in recent years, have also shown signs of weakness. This development has sent ripples through the financial world, causing investors to reassess their strategies and portfolios. Companies like Apple, Amazon, and Microsoft, often seen as bellwethers for the broader tech sector, have experienced declines in their share prices, reflecting concerns about slowing growth, supply chain disruptions, and the impact of rising interest rates on their future earnings potential. These issues are compounded by global economic uncertainties, making it difficult for these giants to maintain their previous growth trajectories. The tech sector's stumble has had a particularly pronounced effect on the London Stock Exchange, as the FTSE 100 index includes several prominent tech and tech-adjacent companies with global reach. The interconnectedness of global markets means that troubles in the US tech sector can quickly spread to other financial hubs, including London. These companies, while headquartered in the UK, often generate a significant portion of their revenue from international markets, including the US. This global exposure makes them vulnerable to economic shifts and policy changes in other major economies, further complicating their financial outlook. Therefore, when the US tech sector experiences a downturn, these UK-listed tech giants feel the pinch, contributing to the overall decline of the FTSE 100. The correlation between US and UK tech stocks underscores the global nature of the tech industry and the widespread impact of its fluctuations. The tech sector's woes have further eroded investor confidence, as these companies were once seen as engines of growth and innovation. Their struggles have led to a broader re-evaluation of the tech sector's role in the global economy, with some questioning whether the era of rapid tech-driven growth is coming to an end. Their recent struggles have cast a shadow of doubt on the market's ability to sustain its upward trajectory, prompting some investors to adopt a more cautious approach and reduce their exposure to riskier assets, including tech stocks. This cautious sentiment is reflected in the behavior of both individual and institutional investors, who are increasingly seeking stability over high returns. This shift in sentiment has exacerbated the downward pressure on the London Stock Exchange, as investors seek refuge in perceived safer havens. The flight to safety has seen increased interest in more stable investments, such as government bonds and blue-chip stocks, further highlighting the current volatility in the tech sector. Section 4. A global shift, seeking safer havens. The confluence of economic and geopolitical uncertainties has triggered a global flight to safety among investors, further impacting the London Stock Exchange. With rising tensions and unpredictable economic policies, investors are increasingly wary of the potential for sudden market downturns. When faced with heightened risk and volatility, investors often move their money out of stocks, perceived as riskier assets, and into assets considered safer and more stable, such as government bonds, gold, or the US dollar. This shift is driven by the desire to preserve capital and avoid the potential losses associated with more volatile investments. This flight to safety has led to a surge in demand for UK government bonds, also known as gilts, pushing down their yields. The increased demand for these bonds reflects a broader trend of seeking stability in uncertain times. While lower bond yields might seem like a positive development, they can signal a lack of confidence in the broader economy and a belief that interest rates may need to remain lower for longer to support economic growth. This can have far-reaching implications for both investors and policymakers. This can create a challenging environment for equities, including those listed on the London Stock Exchange, as investors become more risk-averse and seek out the relative safety of government bonds. The shift away from equities can lead to reduced liquidity and increased volatility in the stock market. The current market environment highlights the interconnectedness of global financial markets and the speed at which investor sentiment can shift in response to economic and geopolitical events. A single piece of news can ripple through markets worldwide, affecting investor behavior and market dynamics. The flight to safety, while understandable in times of uncertainty, can exacerbate market volatility and create a self-fulfilling prophecy, as selling pressure begets more selling pressure. This heightened volatility can make it difficult for investors to navigate the market and make informed decisions. This dynamic can lead to a vicious cycle, particularly in the absence of positive news or policy interventions to restore confidence. Policymakers play a crucial role in stabilizing markets by implementing measures that can reassure investors and mitigate the impact of negative sentiment. Without such interventions, the market may continue to experience heightened volatility and uncertainty, further complicating the investment landscape. Section 5. The impact on British shores. Workers and investors brace for impact. The downturn in the London Stock Exchange has significant implications for British workers and investors alike. For individuals with pension funds or other investments linked to the stock market, The recent decline translates into a reduction in the value of their savings and retirement nest eggs. This can be particularly concerning for those approaching retirement, as they may have less time to recover from these losses. Furthermore, the stock market slump can have a wider impact on the British economy. A prolonged downturn can dampen consumer and business confidence, leading to reduced spending and investment. This in turn can negatively impact economic growth and potentially lead to job losses, as companies tighten their belts in response to the uncertain economic outlook. Moreover, the decline in the value of the pound sterling against other major currencies, such as the US dollar, can contribute to imported inflation, making it more expensive for British consumers to purchase goods and services from abroad. This can further squeeze household budgets and potentially limit consumer spending, further impacting economic growth.